Hi, this is Dan Collins, Editor-in-Chief of Futures Magazine for Traders Exclusive. And this morning I want to talk a little bit about tapering versus tapering once again. I know it's kind of been a really difficult debate for some people to talk about because they assumed tapering was tightening. And we just saw recently some strength in the U.S. Treasury bond and note complex, and that has some people perplexed. But they really shouldn't be. I mean, tightening, and part of that was the Federal Reserve, new Fed Chairman Janet Yellen talking that tightening could occur as soon as 6 months after the end of tapering. But remember that the Fed has been adding liquidity. They have been purchasing long-term interest rates to support, to keep bond prices down. Because the reason they're doing that is because we've had this great recession, and their power over the Fed funds rate, keeping it at zero, can only affect that bottom part of the curve. So in order to keep interest rates low, they had to purchase bonds. Now, they were purchasing 85 billion combined of long-term bonds as well as the mortgage-backed securities. They're down, they dropped it by 30 billion, so it's now at 55 billion. And if they continue to taper at every meeting, I think that goes off sometime around October. And according to Yellen, that means they could start tightening maybe in the second quarter, beginning of the second quarter of 2015. So there's really no cause for panic, and that's probably, and she stepped back from that. But you got to remember, as long as you're doing, as long as QE is still going on, you're adding. So it's really not even a beginning of an exit. You have to get to zero before you can start exiting. And every month, the Fed continues to purchase these assets. Now, what it means, the tapering means, is as they get smaller and smaller, as QE gets smaller and smaller, then maybe the normal fundamentals will have a bigger role on the fixed income market and on stock market. Because I think it's clear to everyone that QE has been holding up the stock market. Now, it will do that less and less, but remember, QE is still going on. There's still purchasing. That's still, that is still not only accommodative, but it's kind of an active purchasing of assets to try and keep interest rates down. So it's not fair to say that we've already begun unwinding, because we are still, in the accumulative phase. We're just accumulating less assets at the Fed. The good news is, as this goes, and the Fed has been pretty clear that they're going to try and keep this up. They maintain the ability that they could, add back purchases, but I think it's pretty clear that something really dramatic is going to happen for them to slow this down, because, at some point the market's going to have to go on its own, and hopefully that'll be sometime in 2015. But don't expect actual tightening to occur well into 2015, because the long end of the curve can start going up as the Fed purchases less and less long-term bonds as part of QE. This has been Dan Collins for Futures Magazine and Traders Exclusive. Talk to you next time.